There is a combination in smart money trading that once you truly understand it, changes the way you see every chart you'll ever look at. Not because it's complicated, but because when these two things appear together, when a fair value gap and an order block align at the same location, on the same time frame, in the same direction as the higher time frame narrative, the market tends to react at that zone with a precision and a consistency that almost nothing else in technical analysis can match. That combination is what this entire video is about. Individually, each concept is powerful. An order block by itself marks the origin point of an institutional move, the last candle or sequence of candles, where a large participant was actively building a position before price displaced aggressively in one direction. A fair value gap by itself marks the imbalance left behind when price moved so fast through a range that normal two-sided price discovery never happened there. Both of them, on their own, are worth understanding and worth watching. But when they appear together, when the order block that originated a move is sitting inside or directly adjacent to the fair value gap that the same move created, you have something different. You have a zone where institutional origin and structural imbalance are stacked on top of each other. A zone where the market has two separate reasons to react. A zone where, when price returns, it isn't just revisiting a pattern. It's returning to the most structurally significant area the move left behind. And that's what we're going to build from the ground up today. We'll look at what makes this combination so reliable, and then we'll walk through multiple concrete examples on the same instrument. Watching the combo form, watching price return to it, and understanding exactly how to identify it, how to time the entry, and how to manage the trade from beginning to end. Before we look at specific examples, it's worth spending a moment on why this combination works the way it does. Because understanding the mechanics behind it, not just the visual pattern, is what allows you to apply it correctly across different instruments and different market conditions, instead of just memorizing a shape on a chart. An order block forms at a very specific moment in the life of a price move. It forms at the moment an institution is finishing the process of building its position. Think about what has to happen for a large buy order to be filled at a reasonable average price. The institution can't just submit the entire order at once. It would move price too far against itself before the order was half filled. So instead, it works the position in over time, accumulating through a series of smaller orders, often disguised as ordinary market activity. That process of accumulation tends to leave a fingerprint, the last bearish candle, or sequence of bearish candles, before a strong bullish displacement is typically where that accumulation was happening. Price was being pushed slightly lower, triggering sell stops, attracting retail sellers who saw the bearish momentum and joined in, generating the supply of sell orders that the institution was absorbing as buy interest. That last bearish candle, or that last consolidation before the impulse, is the order block. Now watch what happens after that order block does its job. The institution has filled enough of its position. The accumulated buy interest exceeds the available sell flow. Price begins to move higher. And it moves fast. It moves fast precisely because the accumulation phase has already happened. There's no more negotiation at those prices. The institution is positioned, and the move begins. That fast movement upward is what creates the fair value gap. When price moves through a range so quickly that the market never finds equilibrium at those levels, when buyers and sellers never properly negotiate at the prices inside that range, a structural imbalance is left behind. The fair value gap is the visible record of that imbalance. It's the area where price skipped over the two-sided market that should have existed there. Now here's why the combination matters so much. The order block is the origin, the last place where the institution was building. The fair value gap is the displacement evidence, the proof that something strong and directional happened right after that origin. When both are present in the same zone, and when price later returns to that area, it's returning to the single most institutionally significant location the move left behind. The zone where the original position was built, and the zone that the market skipped over too quickly to properly discover price. That's the structural logic behind why this combination produces reactions with the consistency it does. It's not a pattern. It's a location. And it's a location that the market remembers. Now let's look at the chart in front of us and watch this develop in real conditions. The instrument here is Euro to US dollar, and we're starting on the 4-hour time frame. The overall context on the daily is bullish. The daily structure has been making higher highs and higher lows, and the most recent daily candle closed as a strong, bullish engulf near what used to be a resistance level, confirming that the structure has broken and that level is now acting as support. That daily context matters because everything we're about to watch on the 4-hour exists inside a market that is, at the macro level, trying to go higher. On the 4-hour, there's been a pullback for the last 2 days, not a violent pullback. A gradual, measured sequence of lower closes that has brought price down from the recent 4-hour high into what now appears to be a zone of potential interest below. The pullback has the texture of profit-taking rather than reversal. The candles are relatively small, the ranges are contained, and there's no real momentum behind the selling. Look at where the pullback is heading. 2 sessions ago, there was a sequence of candles on this 4-hour chart that stood out. 4 bearish candles, each one closing slightly lower than the previous, with contained bodies and relatively ordinary ranges. And then, without warning, a single 4-hour candle that opened near the close of the previous bearish candle and drove higher, with a range nearly 3 times the size of the preceding candles. Strong body, minimal upper wick, close near the top of the candle. That single bullish candle was the displacement. Something directional and committed drove price through that range. And the 4 bearish candles that preceded it, the last sequence of selling before that displacement, those are the order block, the last place where supply was being absorbed before the move began. Now look at what that displacement left behind. Between the low of the displacement candle and the high of the candle immediately before it, there's a gap. A range of prices where the 4-hour chart never traded properly. The displacement candle simply moved through those levels without the normal back and forth that characterizes balanced price action. That gap is the fair value gap. And notice where it sits. It sits directly inside the order block zone. The prices that make up the fair value gap are the same prices that were being traded during the last bearish candles of the order block sequence. The imbalance the displacement created is sitting right on top of the origin point of the move. That overlap, that stacking of the FVG directly on top of the order block, is exactly what we're watching for. And the current pullback, the 2-day retracement on the 4-hour, is heading directly toward it. As the 4-hour pullback continues, drop down to the 1-hour chart and watch the behavior of the candles as they approach the zone. Something specific tends to happen as price approaches a valid order block and FVG combination. The momentum of the pullback starts to fade. Not because of any arbitrary support level, not because of a moving average or a trend line, but because the closer price gets to the zone, the more institutional interest begins to reemerge. The buyers who originated the move are watching this same area. Their reference point for re-entry is the same zone we've identified, and as price approaches it, their limit orders, sitting at the prices inside the order block and FVG, begin to absorb the remaining sell flow from the pullback. Watch the candle ranges on the 1-hour. 3-4 sessions into the pullback, the ranges start to narrow. The candles that were producing 20 or 30 pip moves are now producing 10 pip moves. The closes are clustering. The market is compressing as it enters the zone. Then, inside the zone itself, something shifts. A 1-hour candle closes with a long, lower wick and a bullish body. The next candle opens higher. The one after that extends the range of the previous. The internal structure of the 1-hour pullback. The sequence of lower highs and lower lows that defined the correction breaks. A higher high forms on the 1-hour. The correction has ended. That break of the 1-hour correction structure, occurring inside the 4-hour order block and FVG zone, is the signal. Not the touch of the zone, not the entry into the zone. The structural shift inside the zone. That's the confirmation that the institutional buyers have re-engaged, that the zone has done its job, and that the 4-hour move is likely resuming from exactly here. This is the entry. On the 1-hour, as the internal higher high forms, or on the 15-minute for additional precision, as the 15-minute structure confirms the shift with its own change of character. The stop goes below the lowest wick that entered the order block zone, not below some arbitrary distance, below the structural boundary of the zone itself, the point at which, if price reaches it, the institutional logic behind the entry is no longer intact. The target is the previous 4-hour high, the last significant structural high before the pullback began. That's where the buy-side liquidity is sitting. That's where the stop losses of short traders who entered during the correction are clustered. That's the next logical destination for price. Let that trade develop. The 1-hour structure shifted inside the zone. The entry was clean. And now the 4-hour move has resumed. Watch what happens over the following sessions. The first leg higher off the order block and FVG zone is sharp. The kind of clean, fast move that happens when institutional buying is fresh and committed. Candles close near their highs. The ranges are wide. The move has the opposite texture of the pullback that preceded it. Instead of narrow, compressed, hesitant candles, these are wide, decisive, directional. About halfway to the target, the 4-hour chart shows a brief consolidation. 2 or 3 candles with overlapping bodies, neither making meaningful progress higher nor giving back meaningful ground. This is normal. It's the market pausing to allow partial exits, to let the weaker hands close their positions, to briefly rebalance supply and demand before the next leg continues. It is not a reason to exit the trade. The structure hasn't broken. The direction hasn't changed. The consolidation is a pause, not a reversal. When the consolidation breaks to the upside, a single 4-hour candle clearing the consolidation high with a strong body, the move accelerates again. The remaining distance to the target compresses quickly. The target is hit as a single 4-hour candle sweeps through the previous high, extends slightly above it to trigger the buy stops clustered there, and then closes slightly below. That minor sweep of the previous high is the exit signal. Not because the move is necessarily over in the larger context, but because that's the point at which the trade has done what it was designed to do. The liquidity above the previous high was the target. It's been reached. The position is closed. Now, critically, look at what that upward displacement just created. That final move into the previous high, the aggressive candle or sequence of candles that drove price from the consolidation to the target, left behind something familiar. Somewhere inside that displacement, there's a gap. Candles moved too quickly through a range for normal price discovery to occur. A new fair value gap has formed. And below that fair value gap, the last bearish candles before the displacement began. The candles that represented the final supply being absorbed before the breakout, form a new order block. The process is self-renewing. Every significant move creates the conditions for the next setup. The order block and FVG that just served as the entry zone for the completed trade are now reference points for the next pullback. And the new order block and FVG created by the most recent displacement are the zones that the next pullback, when it comes, will likely target. This is how you start to read a chart, not as a series of isolated setups, but as a continuous institutional narrative. each move generating the structural conditions that define the next opportunity. Let's stay on the same chart and watch the next setup develop. The 4-hour has now made a new high. The daily structure remains bullish. The higher high we just witnessed is a confirmation of that. The daily context hasn't changed. The market is still structurally trying to go higher, and every meaningful pullback is an opportunity to buy, not a reason to panic. But something interesting is happening on the 4-hour now. The pullback following the new high is different from the previous one. The first pullback was slow, measured, compressed. This one has more energy behind it. The candles are slightly larger. The ranges are wider. There's more selling pressure in this correction than there was in the last one. This matters because it tells us something about where the valid order block and FVG for this sequence might be. A more aggressive pullback will often move through the first minor zone it encounters. It won't stop at the shallowest imbalance. It needs to reach deeper, to the zone where institutional interest is strong enough to absorb the additional selling. Look at the structure of the current displacement that created the new high. There was a sequence of consolidating candles before the breakout. A 2-session range where price moved sideways before the impulsive candle drove higher. The last bearish candle of that consolidation, the one immediately preceding the breakout candle, is the order block. And the displacement itself created a fair value gap that extends from the bottom of the breakout candle to the top of the last consolidation candle. But here's what you need to notice. That fair value gap from the most recent displacement sits higher on the chart than the one we used for the previous trade. And the current pullback, with its increased momentum, has already moved through the upper portion of that new zone. The aggressive selling has taken price below the midpoint of the new fair value gap. This is a decision point. And the decision is based on one question. Has the institutional origin of the move, the actual order block, been violated? If the pullback has moved through the fair value gap, but is still above the order block, the zone may still be valid. The imbalance is being filled, but the origin is intact. If the pullback has moved below both the fair value gap and the order block, the zone has been violated, and the setup is no longer valid. Look at the chart. The pullback has entered the fair value gap, but is still above the last bearish consolidation candle that marked the order block. The zone is being tested, not broken. The structure of the setup is intact. Now on the 1-hour chart, the behavior inside the zone this time is more complex than the clean reaction we saw in the previous setup. Instead of a quick wick and immediate bullish recovery, the 1-hour candles are spending more time inside the zone. 2 full 1-hour sessions have now closed inside the fair value gap. Price is negotiating at these levels rather than rejecting them immediately. This is important to understand because many traders see price entering a zone, spending time there, and interpret it as the zone failing. They get anxious. They wonder if the setup is wrong. And sometimes that anxiety causes them to exit before the actual reaction occurs. Spending time in a zone is not the same as violating it. As long as the order block itself, the structural origin of the move, has not been closed below on a meaningful time frame, the zone remains valid. What's happening during those 2 1-hour sessions inside the fair value gap is that price is finding the equilibrium that was skipped during the displacement. The two-sided market that should have existed at these prices is now occurring, briefly, in a contained way. Before the institutional buyers who placed limit orders at these levels absorb the remaining supply and begin to drive price higher again. Watch the third 1-hour candle inside the zone. It opens inside the fair value gap, moves slightly lower during the session, touches the upper portion of the order block, and then, in the final portion of that candle, the selling stops. The close is above the open. A bullish candle body inside the zone, with the wick testing the order block and finding support there. The next candle extends higher, and the candle after that breaks the high of the first rejection candle. The structural signal that the 1-hour internal structure has shifted from the corrective lower high sequence of the pullback to a new higher high. The internal change of character has occurred, later than in the previous setup, but cleaner for the waiting. The zone held. The entry is valid. Same mechanics as before. Entry on the 1-hour internal structure. Shift inside the zone. Stop below the lowest wick that entered the order block. Target at the next structural high. The buy-side liquidity sitting above the most recent 4-hour high, where short sellers from the current correction have their stops, and where breakout buyers waiting for a new all-time high have their orders. There's a version of this setup that looks almost identical but doesn't work. And understanding the difference between a valid order block and FVG combination and a similar-looking but structurally weaker zone is one of the most important practical skills you can develop. The version that doesn't work tends to appear in the same place at a similar visual level and with a similar surface structure, but it lacks one or more of the conditions that make the valid setup reliable. The first warning sign is a fair value gap that formed without a genuine order block beneath it. This happens when price moves impulsively upward, but the candles before the impulse don't have the character of institutional accumulation. Instead of a sequence of contained bearish candles, the patient, deliberate absorption that marks an actual order block, the candles before the impulse are mixed, choppy, inconsistent. A little up, a little down, no clear direction. When price then displaces higher and creates a fair value gap, that gap lacks the institutional origin that gives the valid combo its strength. There's no clear last bearish candle or sequence that defines the zone. There's no location where the institution was accumulating before the move. The fair value gap is real, but it's unanchored. It's an imbalance without a structural origin. When price returns to that kind of zone, the reaction tends to be inconsistent. Sometimes it holds, sometimes it doesn't, and you can't tell in advance which it will be because the zone lacks the structural backing that makes it predictable. The second warning sign is an order block that has been tested too many times. An order block is strongest the first time price returns to it. When the institutional interest that originally created it is still fresh, still referencing those price levels, still likely to re-engage there. Each subsequent test of the same zone reduces its reliability. On the second test, the institution may add to its position, but with less size. On the third test, a portion of the original interest may have already been satisfied. By the fourth or fifth test, the zone has been so thoroughly mitigated that the institutional memory of it has largely faded, and the reaction, if there is one, is unlikely to be meaningful. On the chart we've been watching, both of the setups we identified were first touch reactions to their respective zones. That first touch quality is part of what made them reliable. When you see a zone being approached for the second or third time, reduce your expectations for the strength of the reaction or skip the setup entirely and wait for a fresh zone to develop. The third warning sign is a zone that forms on a lower time frame in direct opposition to the higher time frame narrative. A bullish order block and FVG on the 15-minute in a market where the 4-hour structure is clearly bearish has very limited probability of producing a meaningful reaction. The lower time frame institutional interest that created the zone is working against the higher time frame institutional flow, and higher time frame flow almost always wins. This is one of the most common errors in applying this methodology, seeing a clean-looking zone on a lower time frame and entering without asking whether the higher time frame context supports the direction. Every valid setup in this methodology has the higher time frame narrative behind it. Without that context, even a visually perfect zone is structurally compromised. Let's pull back to the daily chart for a moment and look at the bigger picture of what's been developing. The daily has now made 3 consecutive higher highs. Each high was preceded by a pullback, and each pullback found support and resumed the uptrend. But the most recent pullback, the more aggressive one we just watched on the 4-hour, went deeper than the previous two. The daily candle that represented the deepest point of that pullback was a large bearish daily candle with a long lower wick, followed by a strong bullish close the next day. That sequence on the daily, a bearish candle with a strong rejection at the low, followed by a bullish close, is a daily order block forming in real time. The bearish daily candle, with its aggressive lower wick, represents the final absorption of sell-side pressure at the daily level. The institutional buyers who operate on the daily time frame stepped in during that candle's session. They absorbed the selling. And the strong bullish close the following day confirmed that the buying interest had overwhelmed the selling. The fair value gap on the daily is the gap between the low of the bullish close candle and the high of the candle immediately before the bearish day. As the daily now pulls back again, as the market creates its next corrective sequence after the most recent new high, this daily order block and FVG zone below will serve as the macro context for the next cycle of 4-hour setups. When the daily pullback eventually reaches or approaches this zone, the 4-hour will begin showing its own order block and FVG setups inside it. The 4-hour setups inside a daily zone carry more weight than a standalone 4-hour setup because you have institutional interest operating at two different time frame levels at the same location. The daily buyers are re-engaging. The 4-hour buyers are re-engaging. Both groups are referencing essentially the same price area. The resulting reaction, when it comes, tends to be stronger, faster, and more committed than a single time frame setup alone. This is the deeper value of multi-timeframe awareness, not just using higher time frames to confirm direction, but using them to identify zones where multiple layers of institutional interest overlap, because those zones produce the highest quality reactions. Come back to the 4-hour chart now and watch the next pullback begin. After the second trade reached its target and was closed, the 4-hour made one more push higher, a brief 3-candle extension that broke the previous high cleanly and created a new one. That push higher was the expected continuation of the bullish structure we've been in throughout this analysis. And with the new high now established, a fresh pullback has begun. This pullback has a different character again, where the first was slow and compressed, and the second was more energetic. This third pullback, after 3 consecutive higher highs, has a liquidation quality to it. There's a sense that some of the long positions built during the entire uptrend are being unwound. The selling is deliberate. It's not panic, but it's not casual either. It has intent. Look at where the pullback is heading. Below the current price, there are now 2 zones that qualify as order block and FVG combinations. The first is the zone from the second setup, the one we already used, which is a second touch zone now and therefore less reliable, but still structurally present. Below that deeper is the zone from the first setup. That zone has been fully tested once, and price has moved well away from it since. A return to it now would represent a deep retracement into an older zone. Neither of those is the primary candidate for the next setup. The primary candidate is the fresh zone that the most recent displacement, the 3-candle push to the new high, just created. The last bearish candle or set of candles before that final extension higher is the new order block. The fair value gap that the extension left behind sits just below the new high. This zone hasn't been touched yet. It's a first touch zone. The institutional buyers who drove that final extension are still referencing those prices. The current pullback is heading toward it. Watch the distance close. As the pullback approaches the new zone, there's a detail on the 4-hour worth paying attention to. The candles are moving lower with a rhythm, a step-down pattern where each session makes a slightly lower low before stabilizing briefly and then stepping down again. That rhythm is the signature of a controlled, engineered pullback, not chaos, not panic, a structured decline with a specific destination. On the 1-hour chart, the internal structure of the pullback is doing what internal pullback structures always do inside a bullish market, making lower highs and lower lows, compressing as they approach the zone, and preparing for the structural shift that will signal the resumption of the higher time frame move. Here, though, something worth watching happens before price reaches the order block and FVG zone. On the 1-hour, a relatively minor bounce occurs, about halfway between the new high and the zone below. Price pushes up for 3 or 4 1-hour candles, makes a minor high, and then turns lower again. That minor 1-hour bounce creates a 1-hour structure that retail traders will notice. They'll see it as a potential buy, a pullback finding support, showing a higher high on the 1-hour, offering what looks like a clean entry in the direction of the 4-hour trend. And some of them will enter there, with stops below the most recent minor low. But look at the distance between where that minor bounce ended and where the actual order block and FVG zone sits below. The pullback from that minor bounce is going to make new lows. It's going to continue lower toward the zone. And as it does, every stop loss from every trader who entered that premature 1-hour bounce will be triggered. By the time price reaches the actual order block and FVG zone, it will arrive with a burst of sell-side order flow. The stop losses from those premature longs, the fresh shorts from traders who see the breakdown of the minor 1-hour support, the breakout sellers who enter as each minor low is taken. All of that liquidity arrives at the zone at the same time, and the institutional buyers waiting at the order block absorb it. This is the full picture of why the zone works. It's not just that institutional buyers are there, it's that the path to the zone generates the liquidity those buyers need to fill their position. The premature buyers provided the stop losses. The stop loss triggers provided the sell flow. The sell flow fed the institutional buy orders. And now, with the position filled, price reverses. The reaction inside the zone follows the pattern we've now seen twice, with one additional refinement worth studying. On the 1-hour, price enters the fair value gap. It moves through the upper portion of the gap over 2 candles, then enters the order block level below. The third candle inside the zone has the specific character we've been looking for. The lower wick, the bullish body, the close above the open. But this time, on the 15-minute chart, there's an additional signal available before the 1-hour candle fully closes. On the 15-minute, as price enters the order block, a microstructure develops. A 15-minute candle sweeps below the previous 15-minute low, triggering the last batch of stops from any remaining sellers, and then immediately recovers. The body of that 15-minute candle closes back above the low it just swept. A 15-minute internal change of character follows. The very next candle closes above the high of the sweep candle. For traders who want the earliest possible entry with the tightest possible stop, that 15-minute structure shift inside the 4-hour zone is the precision trigger. The entry comes on the close of the 15-minute change of character candle. The stop goes below the lowest wick of the 15-minute sweep, a tight structural level that clearly defines where the zone has been violated. For traders who prefer the additional confirmation of the 1-hour internal structure shift, that signal comes within the next 1 or 2 1-hour candles after the 15-minute trigger. Slightly later entry, slightly wider stop, but with the additional evidence of a higher time frame confirmation. Both entries are valid. The 15-minute entry captures more of the initial move and offers a tighter stop-to-target ratio. The 1-hour entry sacrifices some entry quality for additional confirmation. Which one you use depends on your personal tolerance for uncertainty and your preference for execution precision versus entry confirmation. What matters is that either way, the structural logic is the same. The zone was valid. The pullback generated the liquidity. The institution absorbed it. The reaction began. The trade is in alignment with the daily and 4-hour narrative. The stop is structural. The target is the next liquidity pool above. By now, you've watched 3 setups develop on the same instrument, in the same directional narrative, using the same combination of order block and fair value gap. Each setup had its own specific character. A slow and clean first reaction, a more complex second reaction that required patience inside the zone, and a third setup where the path to the zone itself was part of the mechanism. But the underlying logic was identical in all 3 cases. Let's now reverse direction and look at the bearish version of this combination, because the instrument we've been watching has eventually reached a higher time frame level that's changed the narrative. And the same tools that identified the bullish entries will now identify the bearish ones. The weekly chart tells the new story. The multi-month uptrend that gave us the daily bullish context for all 3 trades has now brought price into a significant weekly premium zone. Not a minor level, a zone that defined the all-time high structure before a major bearish move over a year ago. Price has returned to this zone after a sustained recovery, and the weekly structure is beginning to show signs of distribution. The last 2 weekly candles are instructive. The first closed with a small bearish body and a significant upper wick. The market attempted to push higher into the zone and was rejected. The second closed with a larger bearish body, still with an upper wick, but now with a meaningful bearish close that has taken out the previous week's low on the close. That sequence, a small rejection followed by a larger bearish candle that breaks a structural low on a weekly close, is a weekly bearish order block developing at a premium zone. The daily context has shifted with it. Where the daily was previously making higher highs and higher lows, the most recent daily structure has a different character. The last daily high is lower than the one before it. The most recent daily candle closed with a large bearish body that swept through 2 sessions of prior daily support. The daily structure is showing its first signs of shifting from bullish to bearish. The 4-hour will show us the entry setup. On the 4-hour, the shift that the daily is beginning to show is already more advanced. The 4-hour has made a clear bearish structural break. The last 4-hour higher low has been taken out, and the candle that took it out was a strong, committed bearish displacement. That displacement left behind a bearish fair value gap above the current price, and the last sequence of bullish candles before the displacement. The final push higher that failed to make a new high, and then gave way to the bearish impulse. Those candles are the bearish order block. The bearish order block and FVG combination is sitting above. The current 4-hour price is below both of them, having displaced aggressively lower through a range that those levels now look down on. A correction has begun. The 4-hour is pushing back up after the bearish displacement, a natural retracement after an aggressive move. Retail traders watching this recovery will see it as a potential buying opportunity. The daily was bullish for so long that the instinct to buy pullbacks is strong. Some will enter longs here, believing the brief correction is resuming the longer trend. But the weekly context has changed. The daily context is shifting. The 4-hour has broken structure bearishly, and above the current corrective push, there is a bearish order block and FVG zone waiting to be tapped. Watch the correction develop. The 4-hour recovery candles are smaller than the displacement candles that preceded them. The bodies are modest. The momentum is clearly weaker on the way up than it was on the way down. This is corrective structure, the kind that builds when the market is retracing temporarily rather than reversing structurally. Each candle upward brings price closer to the zone above. On the 1-hour chart, the correction resolves into a compression pattern as it approaches the bearish order block and FVG zone. The candles narrow. The ranges shrink. The 1-hour structure inside the correction has been making higher highs and higher lows. The internal bullish structure of the correction. But now, at the boundary of the zone, that internal bullish structure stalls. A single 1-hour candle enters the lower portion of the bearish fair value gap. It pushes up through the gap's lower boundary, reaches toward the order block level above, and then, on the same candle, reverses. The candle closes at the lower end of its range, an upper wick inside the zone, with a close back near the bottom of the candle. That's the rejection signature. That's the institution selling into the recovery, distributing supply to the retail buyers who are still looking upward. The next 1-hour candle opens and moves lower. Then the one after that breaks the low of the rejection candle. The internal bullish structure of the correction, the higher high and higher low sequence that define the retracement, has been broken by a lower low. The 1-hour change of character has occurred inside the bearish order block and FVG zone, in alignment with the 4-hour bearish displacement and the daily and weekly shifting context. The short entry is taken as the 1-hour internal structure breaks. Stop above the highest wick that entered the bearish order block zone. Target at the first significant 4-hour sell-side liquidity below, the swing low created by the bearish displacement, where the stop losses of any remaining longs are sitting, and where breakout shorts waiting for that low to be taken have their entry orders. The trade is structurally clean. Every time frame from weekly down to 1 hour is aligned. The zone was fresh, first touch. The rejection inside the zone was clear. The internal structure shift confirmed the move. Something worth pausing on here is the relationship between patience and setup quality, because it shows up clearly when you watch multiple examples on the same instrument. In the 3 bullish setups we watched, the temptation at every stage was to enter earlier than the structure warranted. On the first setup, the temptation was to enter when price first touched the fair value gap, before the internal structure shift confirmed the reaction. On the second setup, the temptation was to exit when price spent multiple candles inside the zone, without immediately rejecting. On the third setup, the temptation was to enter the premature 1-hour bounce, before price reached the actual zone. In every case, acting on that temptation would have produced a worse outcome. A worse entry price, a wider stop, a weaker risk-to-reward ratio, and in some cases a full stop out before the actual move began. The bearish setup showed a similar dynamic. The correction back into the bearish zone was a convincing recovery. 2 full sessions of higher closes on the 4-hour internal 1-hour bullish structure that looked like a legitimate trend. Entering short before the zone was reached, simply because the 4-hour narrative was bearish, would have meant entering into the corrective momentum, being short while the market was temporarily pushing higher, watching an unrealized loss build before the zone finally rejected. Patience in this methodology is not about missing moves. It's about not paying for unnecessary risk. Every candle you wait for after the first touch of a zone is a candle that gives you more information about whether the zone is going to hold. Every internal candle that closes bullishly inside a bearish zone tells you the selling hasn't started yet. Every candle that enters the order block level without rejecting tells you the absorption isn't complete yet. The signal, when it comes, is worth the wait. And when it doesn't come, when price blows through both the fair value gap and the order block without reaction, you've learned something valuable. The zone was not the destination this time. Something deeper is being targeted. And the market will tell you what. The final example worth examining is the one that tests the methodology directly. A scenario where the zone that should have held didn't, and understanding why. After the bearish entry we just described, the trade moved well toward its target. The 4-hour sell-side liquidity was reached within 3 sessions, generating a strong partial close and a stop move to break even. The first target was satisfied, but the second target, the deeper sell-side liquidity pool below the first, required additional movement through an area that contained a 4-hour bullish order block from much earlier in the uptrend. That older bullish order block was the footprint of one of the first major institutional buy campaigns that began the entire multi-month uptrend we analyzed. It had been tested once before and held cleanly. Now, on a second test from above, it sat directly in the path of the bearish continuation. The market reached that older bullish order block zone and reacted. Not dramatically, but enough. A single 4-hour candle closed bullishly from inside the zone. Then another. The bearish momentum faded. The correction from that zone pushed up high enough to sweep the stop on the remaining bearish position, which had been moved to break even after the first target. The trade exited at break even, not a loss, but not the second target either. What happened structurally was that the older bullish order block, even on its second test, retained enough institutional interest to temporarily interrupt the bearish move. The institutions that originally bought from that zone still had an active reference to those prices. On the second visit, enough of them re-engaged to create the brief bullish reaction that swept the stop. This outcome isn't a failure of the methodology. It's evidence that the methodology is working correctly, including the part that says an older zone on its second test is less reliable, but still potentially significant enough to cause a reaction. The first target was hit cleanly. The second target was blocked by an older competing zone. The stop, having been moved to break even, protected capital. The lesson is structural. The market is full of overlapping zones from different time frames and different points in the historical price narrative. Sometimes two zones from different origins sit close enough together that they create a tug-of-war effect. When you're managing a live trade and you see an opposing order block or FVG zone sitting between your current price and your second target, that's the moment to consider taking additional partial profit, tightening the stop more aggressively, or lowering your expectations for the full second target being reached cleanly. The zone that stopped the move wasn't a surprise. It was visible on the chart before the trade was entered. Knowing it was there and accounting for it in the position management is the difference between being caught off guard and being prepared. Look at the full picture of what this instrument has shown us across this analysis. Multiple bullish order block and FVG setups, each one generated by the same structural logic. A displacement creates an imbalance. The last candles before the displacement mark the origin. The pullback that follows targets that origin and imbalance. And the institutional buyers who created the original move re-engage at the zone. 3 setups, each with its own specific texture, clean, complex, deep, but all sharing the same fundamental structure. Then a shift in the higher time frame narrative, the weekly premium zone, the daily structural change, the 4-hour bearish displacement. And immediately, the same combination appears in the opposite direction, a bearish order block and FVG zone, sitting above the corrective push, a rejection inside the zone, a 1-hour internal structure shift, a short entry in alignment with every relevant time frame. The methodology didn't change. The direction changed. The logic was the same. The zones were different. The instruments were at different price levels, but the mechanics of identifying and entering the setup were identical. That consistency, the fact that the same structural logic applies bullishly and bearishly on different time frames, across different instruments, in different market conditions, is what gives this combination its durability as a trading approach. It doesn't depend on a specific market environment. It doesn't work only in trending markets or only in ranging markets. It works wherever institutions are building and distributing positions, which is everywhere, always, on every instrument that has meaningful participation. To close this analysis, think about what it would mean to approach every chart you look at with this framework active in your mind, not as a checklist, not as a rigid system where you search for the pattern and enter when you find it, but as a way of reading price that asks, at every significant move, what kind of displacement just happened? What did it leave behind? Where is the zone that the next pullback will likely target? And what confirmation will I require before acting? When you see a strong bullish displacement, you're not thinking buy immediately. You're marking the fair value gap it created. You're identifying the last bearish candles before it as the potential order block. You're watching the subsequent pullback with the question, is this heading toward the zone? And what will the candle behavior inside the zone look like when the reaction begins? When the pullback reaches the zone, you're not forcing an entry on the first touch. You're reading the candles as they develop inside the zone. You're watching for the compression, the wick, the internal structure shift, the change of character that signals the institutional buyers have absorbed the remaining supply and the move is resuming. When the internal signal comes, you're entering with a structural stop and a liquidity-based target, with the full weight of the multi-timeframe narrative behind the trade. That's the full loop: displacement, zone identification, pullback, zone reaction, entry, management, target. It runs continuously on every time frame, generating setups as regularly as the market generates moves. The tools are always the same. The application is always contextual. The fair value gap tells you where the market moved without equilibrium. The order block tells you where the institution was building before it moved. Together, they tell you where the market is most likely to return to and where it's most likely to react when it gets there. Every chart you'll ever look at is full of these zones. Once you know how to identify them, and once you understand what the candle behavior inside them is telling you about whether the institutional interest at that location is still active, you'll never look at a pullback the same way again. The market is not random noise interrupted by occasional signals. It's a continuous institutional process, leaving structural traces at every significant price level, returning to those traces with predictable regularity, and reacting there with a consistency that rewards the patient, prepared observer. That observer, with this framework,